Mortgage rates have officially hit the highest levels since 2008. It's been over 14 years since we've seen levels like this, and this has largely been a byproduct of the monetary policy of the Federal Reserve. Now, we've been talking about this for a while about how the Federal Reserve's monetary policy and mortgage rates are two of the most important things to keep your eyes on right now, and so far everything that we've been predicting will happen has been coming to fruition. And so because of that, we're beginning to see the start of a more serious housing correction taking place. We saw inflation numbers recently come back worse than expected, and that is only going to provide even more ammunition for the Federal Reserve to get even more aggressive and make decisions that will negatively impact the housing market. So with that said, there's a lot to go over in today's video, but before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Mortgage rates officially hit over 6.33%, and this represents the highest mortgage rates that we've seen since 2008, and really the highest mortgage rates we've seen in this entire cycle. We've been talking about how mortgage rates going up translates to affordability going down, and affordability has really been the biggest problem in this housing market. And the National Association of Realtors actually tracks the statistics as they compare income to the cost of housing to track housing affordability. Now, the last time we saw levels this low as far as housing affordability is concerned was back in 2007 when we saw housing affordability index numbers go down to 100. Well, right now, housing affordability is right around those levels currently. We saw it dip below 100 back in June as mortgage interest rates started to spike up. As the interest rates started to come down a bit, we saw housing affordability go back up over 100 to a level of 102, and so we're floating right around that 100 level at the moment. So we saw mortgage rates go all the way down to 5.05% back in August 1st, and since then we've seen mortgage rates surge over 1.25 percentage points to where we're at now at 6.33%. Now, as far as housing affordability goes, I'm really interested to look for September numbers coming out. Now, I'll tell you why. You see, August numbers are going to be pretty much a wash because half the month we're in the low fives, the other half of the month we're in the high fives, but so far in September we've been in the sixes throughout that entire period. June was mostly in the high fives, and in June we saw the highest, or the lowest rather, affordability level since 1989. So it's going to be interesting to see what the September numbers come back at, especially since affordability is the number one problem in the housing market at the moment. But the number one problem in America at the moment, as far as the Federal Reserve is concerned, is inflation. Well, the numbers came back last week, and we saw the inflation numbers come back showing an 8.3% year-over-year increase, which seemed like it was a pretty good number considering that in July we showed an 8.5% increase. But if you actually look month over month from July to August, we actually saw a 0.1% increase. Now, this was worse than expected because right now we're seeing gas prices go down significantly. Gas is down over 10.6% just month over month, and over 7% the month before that month over month. So when you take that into account, inflation has really not been getting under control as it's really going up aside from gas going down. We actually saw evidence of this as we saw core inflation numbers go from 5.9% in July year over year to now we're at 6.3% year over year. And your core inflation is basically your cost of goods and services, not counting your food and energy sectors. Now, the reason why this is bad news for both the economy and the housing market is the Federal Reserve's number one goal is to lower inflation to those 2% levels. Now, so far we've seen them hike interest rates a total of 2.25%. We do anticipate more interest rate hikes along the way, and we've seen them begin to offload their balance sheet, which starting this month, that's going to double the speed. But even with what they've done so far, it's really proving that inflation is a tougher battle to face than they initially anticipated. It could take over 2 years to get down to those 2% inflation levels, and so what we can anticipate to see is the Federal Reserve is going to likely have to stay aggressive or potentially even get more aggressive than it's been so far in order to achieve their goal. And we haven't even been able able to factor in student loan debt forgiveness yet, which hasn't been done yet officially, and so when that happens, that's only going to add more upward pressure on inflation. Now, regardless of that, we're already beginning to see demand destruction taking place. The Mortgage Bankers Association reported that purchase applications are already down 0.2% week over week. This has been a continued trend we've been seeing over the past several weeks, and now we're at the point where we're actually down over 29% year over year. We're also continuing to see the months of supply rise, as Redfin recently reported that we're currently at about 2.9 months of supply, which is the highest levels of supply we've been at since July of 2020. Pending sales also continues to plummet, as we saw declines of over 19% year over year. But even with demand plummeting the way we're seeing it take place right now, new supply coming on the market is also plummeting as well. You see, new listings are down over 18.6% year over year, as we're also starting to see the amount of total active listings starting to go down as well. Now, it is important to note that there is a difference between months of supply and active listings. Often they get confused between each other. Months of supply is when you take the number of active listings on the market and divide it against the amount of homes sold in the last month. That gives you your total months of supply, whereas your active listings is the total amount of listings on the market. So you can see a decline in active listings, but a rise in months of supply. Now, with that said, the reason we're starting to see active listings fall is there is a growing number of home sellers that are starting to feel like now is not the right time to be selling their house, especially with the way that homes are starting to sit longer on the market. Earlier on in the year, we saw about 16.5 median days on market. Now we're up to over 28 days on market, which even in the last week has gone up another day. We're even seeing more and more sellers choose to take their house off the market and instead rent it out. If you look nationwide, about 4% of home sellers are actually doing this, but in certain areas like Southern California or Texas, you're seeing about 10% or 9% of home sellers choosing to take their home off the market and rent it out instead. Now, on the positive side, at least it adds more supply to the rental market, which desperately needs it right now. As more home buyers get priced out of the housing market, they start to shift their focus to renting instead, and so that's only going to add more demand as mortgage rates continue to rise. So that's not a bad thing to have a little bit more supply on the rental market. Now, with that said, it is important to note that the economy as a whole is starting to slow down. We're already seeing signs of it. And when an economist takes a look at a potential economic crash, in addition to things like GDP, they're also going to look at things like retail sales, industrial production, they're going to look at jobs and unemployment and things of that nature. Well, retail sales numbers recently came back, and we saw that there was an increase month over month from July to August of 0.3%. Now, that might sound like a good thing, but in reality, if we look at the bigger picture, July numbers year over year were at 10.3%, and now we've gone down to 9.1% year over year with August. Secondly, core retail sales was down 0.3% month over month, and that's basically your retail sales not including automobiles, gas, food services, and building materials. Thirdly, and this is the most important point, is that inflation drives up these numbers and kind of creates a false perception. For instance, if you sold 200,000 hamburgers at $5, you get $1 million in sales. You could also sell 100,000 hamburgers at $10 a hamburger and still get $1 million in sales. So that's exactly what we're seeing, because you got to factor in that if you saw 9.1% growth in retail sales with normal inflation at 2%, that's a lot different than seeing inflation at around 8.5% and seeing a 9.1% increase. Now, the Fed is meeting next week, and I'm anticipating to see interest rates hiked a total of 0.75%. That would take us from a total of 2.25% for the year to up to 3% for the year. And I think that that's going to happen because, as we've talked about, inflation is proving to be a much harder battle to face than we initially anticipated. And so I do believe that the Federal Reserve will stay aggressive, and as a result, we are going to be headed towards an economic crash. Eventually, we're also going to start to see unemployment levels rise, and we're actually starting to see potentially early indicators of this, as August numbers came back, going up from 3.5% in July, now up to 3.7%. Doesn't sound like much, but it is the first time we've seen over a 0.1% increase since the start of the pandemic took place. All of this ultimately down the road has an effect on the housing market between mortgage interest rates going up, between the Federal Reserve and what they choose to do with their monetary policy, and what the overall health of the economy looks like. It all plays a role in the overall health of the housing market. So we're going to continue to keep you updated as to what's going on with the housing market. But if you enjoyed today's video and you gained some value today, do me a favor and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know your thoughts in the comments below and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out-of-State Investor. And if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you on the next one.